Hey everyone, welcome back to Corporate Decoder, the place where we take a deep dive into company reports and try to make sense of all the numbers and jargon. Today we're looking at Twin Disc Incorporated's quarterly report, and let me tell you there are some interesting shifts happening under the hood, especially with their recent acquisitions. Stick around as we decode what these financial statements really mean for the company. And before we jump in, if you appreciate getting straight insights from these sometimes dense filings, make sure you are subscribed. We also have a Discord community linked in the description below for deeper discussions on these topics. Alright, let's start by looking at the company's financial position as of the 26th of December 2025. Their total assets were about $384 million. This is up from around $355 million at the end of June 2025. A big chunk of this increase comes from their inventories, which went up to about $163 million. This suggests they might be stocking up, or perhaps demand has shifted. Speaking of inventories, let's look closer at that line item. The company's inventories rose to $163.1 million from $151.9 million. This increase can be seen across finished parts and work in process, while raw materials slightly decreased. This buildup of inventory might be a strategy to meet anticipated demand or a response to supply chain conditions. Now let's talk about the company's performance, the top line, the sales figures. For the quarter ending the 26th of December 2025, net sales were $90.2 million. This is a very slight increase from $89.9 million in the same quarter last year. However, when we look at the first 6 months of the year, sales jumped to $170.2 million compared to $162.8 million in the same period of the prior year. This growth is largely attributed to their acquisitions. The company's manufacturing segment is showing some interesting trends. For the quarter, sales increased by 3.3%. A key driver here is the Kobelt acquisition, which added about $3.2 million in revenue. Operations in the Netherlands and Italy also saw significant growth thanks to strong demand for their propulsion and industrial products in Europe. However, US manufacturing operations experienced a dip affected by shipment delays and softer demand for certain products. On the flip side, the distribution segment took a hit. Sales decreased by a notable 29% in the second quarter of this fiscal year compared to last year. Asian distribution operations were particularly down, and North American and European distribution also saw declines. This suggests weaker market conditions or perhaps a change in how products are being moved through the distribution network. Gross profit as a percentage of sales improved slightly to 24.8% from 24.1%. That prior year quarter had a non-cash inventory write-down of $1.6 million, which skews the comparison. Without that adjustment, the performance looks more stable. However, this quarter faced challenges from a less favorable product mix and some operational issues. Marketing, engineering, and administrative expenses as a percentage of sales increased to 22.9% from 21.0%. This rise in spending is linked to the new acquisitions, the Kobelt purchase adding about $0.5 million, and also currency impacts and increased commission expenses. Interest expense went up by $0.3 million to $0.8 million. This is mainly due to a higher outstanding loan balance following recent acquisitions. Now, here is something quite significant. The company recorded a substantial income tax benefit of $21.8 million this quarter compared to an expense of $1.6 million in the prior year. This is largely due to the reversal of their domestic valuation allowance on deferred tax assets, signaling a more optimistic outlook on future profitability. They expect to be profitable moving forward. Let's touch upon goodwill, which represents the premium paid over the fair value of acquired assets. As of the 26th of December 2025, goodwill stood at $2.9 million, slightly down from $2.9 million at the end of June. This indicates that the acquired businesses are being managed without significant impairments to their goodwill. Intangible assets net of accumulated amortization also saw a slight decrease from $13.4 million to $12.2 million. This reflects the ongoing amortization of these assets, which typically includes things like customer relationships and technology. Know-how, the remaining useful life for these intangibles is about 7 years. The estimated amortization expense for the rest of fiscal 2026 is projected to be around $1.4 million. Looking at long-term debt, it increased overall. Revolving loans, which at the end of June were about $17.9 million, have now risen to $31.7 million. Their term loan remains steady at $12.8 million. This increase in borrowings is directly linked to financing their acquisitions, including Kobelt. The company refinanced its credit agreement in February 2025. This new agreement includes a $15 million term loan and a $50 million revolving credit commitment. The terms are tied to market rates like SOFR or Euribor and involve financial covenants such as a total funded debt to EBITDA ratio not exceeding 3.5 to 1.00, they seem to be in compliance with these covenants. Shareholders' equity saw a significant increase of about $20.8 million to $185.2 million. This growth is driven primarily by $21.9 million in net earnings during the first half of the year. This reflects a solid improvement in the company's book value. The most important number for many investors, net income attributable to Twin Disc Incorporated shareholders, shows a dramatic turnaround. For the quarter ended the 26th of December 2025, it was $22.4 million, a huge leap from just $0.9 million a year earlier. For the first 6 months of the year, it was $21.9 million compared to a loss of $1.8 million in the same period last year. This is a really strong performance driven by the acquisitions and improved operational efficiency in some areas. Regarding stock compensation, the company granted performance stock awards. These awards vest based on achieving specific financial targets like return on invested capital and EBITDA. The fair value of these awards is expensed over the performance period. The company recognized $0.8 million in compensation expense for these awards in the first 6 months of the year. The company also discussed its pension and other post-retirement benefit plans. For pension benefits, the net periodic cost was $1.5 million for the first 6 months of the year. For post-retirement benefits, the cost was minimal at $0.05 million. The company expects to contribute around $0.7 million to its pension plans in the next fiscal year. Foreign currency translation adjustments are notable. For the quarter ended the 26th of December 2025, there was a positive impact of $1 million on accumulated other comprehensive income compared to a significant negative impact of $11.4 million in the prior year. This suggests stabilization or improvement in currency exchange rates affecting the value of overseas investments. The company uses hedging strategies to manage currency risks. Their euro-denominated revolving loan is designated as a net investment hedge, a strategy that recorded a net unrealized after-tax gain of $0.1 million. This indicates that their hedging efforts are helping to offset currency fluctuations on their foreign investments. Looking at the overall financial health, Twin Disc Incorporated appears to be in a stronger position than a year ago. The significant increase in net income driven by acquisitions and operational improvements is a major positive indicator. The reversal of the valuation allowance on deferred tax assets also suggests management's confidence in the company's future profitability. However, the decline in the distribution segment warrants close monitoring. Revenue growth in manufacturing driven by acquisitions is a good sign, but the decrease in US manufacturing sales and the drop in distribution sales highlight geographical and segment-specific challenges that need to be addressed. The increased debt load from acquisitions also needs to be managed carefully, although it appears to be within covenant limits. So what does this all mean for Twin Disc? The company is clearly on an acquisition-driven growth path, and these recent moves seem to be paying off in terms of revenue and profitability improvements. The manufacturing segment is showing resilience, particularly in Europe, fueled by demand for specialized products. However, the distribution segment is facing headwinds, indicating a need for strategic adjustments. The significant tax benefit from releasing the valuation allowance is a strong signal of improved financial outlook. While debt has increased overall, the company seems to have adequate resources and credit lines to manage its obligations. The key going forward will be integrating acquisitions effectively and navigating the challenges in the distribution network. Alright, that is our deep dive into Twin Disc Incorporated's latest quarterly report. What are your thoughts on these numbers and what they signal for the company's future? Drop your opinions in the comments below. If you found this analysis valuable, hitting that like button really helps us out. And of course, subscribe for more. Make sure you check out the Discord community linked in the description for more discussions. Thanks for watching, and we will see you next time.